Financial Modeling, Topic 13, Forward Contracts. Section 2, Compute Theoretical Forward Prices for Equities, Currencies, and Commodities. It could be very difficult to obtain forward market prices because forward contract terms like asset, quality, quantity, and delivery dates are all negotiated between counterparties. A couple benchmarks we have for forward prices are: one, we could look at exchange traded futures prices. For example, the Chicago Mercantile Exchange oil contract is for 1,000 gallons of Brent crude. Or we look at the Chicago Mercantile Exchange cocoa contract, which is based on 10 metric tons of beans of a certain quality. For example, percentage of mold, percentage of foreign matter, and etc. So they provide a benchmark if you're trying to negotiate a forward contract. The second thing we'll often look at is simply the spot price. If you're negotiating a forward contract for a delivery of cocoa beans in 6 months, the first thing I probably look at is what is the price today. We'll often graph the spot price of a particular commodity with, say, the 1 year and 6 months and so on forward prices. And when we graph those terms, we can call that the forward curve. And if the forward price is above the spot price, in other words, it's more expensive to buy an asset in the future with a forward contract, we say that market is in contango. All that means is the forward prices are above the spot prices. If the forward prices are cheaper than the spot prices, we say that that market is in backwardation. So it's simply a graphical representation of today's spot price and forward prices of different delivery dates. So let's talk more about how these prices are determined and how markets could be in contango or backwardation. Before we do that, let's talk about one thing. If a market is in contango today, meaning that the current forward price or futures price is above the current spot price today. So this is a different graph. This is looking at today. This is the forward price for, say, a 1-year delivery, and this is the spot price. And this is, say, the delivery date. This is the maturity date. If the market is currently in contango, the forward price is above the spot. Eventually, the forward price and spot price have to converge to one single value at maturity. If not, there would be ability to get profits. Because if there's a difference between a forward price and a spot price, say on the day of delivery or the day before delivery, I would simply buy in the market that's cheap and sell in the market that's expensive. Say it was cheaper in the spot market, I buy in the spot, and I would enter into a forward contract to sell it at the higher price tomorrow, and so there'll be arbitrage profits. And if the market is in backwardation, in other words, the futures price is below the spot price, again, at maturity, these prices have to converge to the spot, otherwise there'd be arbitrage profits. So let's talk about where these prices could come from. One way to think about a forward price is to calculate what we call as a cash and carry arbitrage price. And we'll just do this for a single stock. We'll talk about a forward price of a stock. So a cash and carry arbitrage is an asset or is a strategy to buy an asset today in the spot market, also called the cash market, and simultaneously enter into a forward contract to sell it later. So I'm going to buy a stock today and enter into a forward contract to sell it in the future. I'm also going to finance that purchase with a risk-free loan. So here's the profit from this cash and carry arbitrage. I'm going to buy the asset today and pay the current spot price. I'm going to finance it at some rate R for the maturity. So at and I'm going to set the maturity equal to the forward delivery date. So again, I'm going to say, let's say T is 1 year. I'm going to buy at the spot price, finance it at some rate R for 1 year, and then simultaneously enter into a forward contract to sell the asset at price F0T, the forward price in 1 year. The profit of this strategy is I'm going to pay off my loan in 1 year. This is the payment of the loan. And I'm going to sell the asset at the forward price and receive F0T. So this is the profit, it's an arbitrage profit. In other words, I used none of my own money since I got a loan, and I no longer have exposed or have any exposure to the stock price because I already own it and I have a contract to sell it. Now there's no arbitrage profits if that forward price is equal to that loan payment. So this is the no arbitrage price for a forward contract. It simply reflects the spot price and the interest rate. Now what we call, in this case, what we call this R, we call the R the cost of carry. In other words, when I buy the stock, I'm going to carry the stock until maturity of the forward contract. The cost of carrying that stock is the interest charge. So what we say is the forward price reflects the current spot price and the cost of carrying the asset. If it doesn't, there would be arbitrage profits. If this stock is a dividend payer, while I'm carrying the asset, I'm paying the interest rate, but I'm simultaneously receiving dividends. So the cost of carrying a dividend-paying stock is R minus D, your financing cost minus your dividend yield. So this is the no arbitrage price that's used as a benchmark for determining what a fair price is for a forward contract. Now, if R is greater than D, in other words, the cost of financing is greater than a dividend yield, then the forward price will be above the spot, and we say the market will be in contango. If dividend yields are greater than interest rates, then the cost of carry is negative, and that market would be in backwardation. The forward price will be below the spot. Now let's just do a little example. Here's a situation a few years ago when the market was in backwardation. At this time period, the spot price of the S&P 500 was $15.97 with a dividend yield of 2%. 2-month, 5-month, and 11-month interest rates, annualized interest rates, were all below 2%. So what we saw is that the no arbitrage forward prices and the market prices for those delivery dates were all below the spot price. The market was in backwardation. And if we just go to Excel file, I just have the calculations for that. We had the spot price, the dividend yield, the interest rates of each maturity. I got the T, which is the fraction of a year, 2 months, 5 months, and 11 months. So the no arbitrage forward prices are going to be equal to the spot, I'll anchor that, times 1 plus the interest rate minus the dividend yield, and that's annualized, I'll anchor that, to the T power. So these are the no arbitrage forward prices for the S&P 500 when the market was in backwardation. In other words, the cost of carry was negative. That forward premium, what percentage is the market below the spot? Well, I can take the forward price minus the spot price divided by the spot price, and you can see the 2-month price was 0.3% below the spot, and then the 5-month and 11-month. So this gives you an idea of how forward prices are determined. It's a no arbitrage argument, which depends on the cost of carry. Let's talk about the cost of carry for a commodity. So for a stock, it's pretty straightforward. The cost of carry is R minus D. The financing rate R minus the dividend yield D. Now let's talk about for a commodity, such as oil, gold, hogs, cocoa. In that case, the cost of carrying a physical commodity is a little bit different. So to execute a cash and carry arbitrage on a commodity, I'm going to buy in the spot market. I'm going to finance it at some rate R. However, if this is, say, a live hog, I'm going to have to pay a farmer, or have to pay to feed and house that pig until the contract matures, So I'm going to also pay a storage cost, S. However, what if I could lease the commodity? Now, for a hog, you're probably not going to lease it, but for some commodities like gold, you could lease it out to short sellers. Also, if I'm holding a commodity, there may be some benefit that I could calculate for having physical ownership of the asset. So, for example, what if I am Samsung and I need gold to produce my phones? If I enter into a forward contract to buy gold in the future, all right, that'll work out well. If I forecast I'm going to need that gold in 1 year, and it works out perfectly, that's a great contract. However, if I hold the gold today, there are some physical benefits for, say, Samsung holding gold today, meaning that if they need it maybe before the actual maturity date, they can say it'd be convenient to actually have that asset on hand. So for any benefits of having a physical ownership of an asset on hand versus a forward contract, we call it the convenience yield. So here is the cost of carrying for a physical asset. I'm going to finance it at some rate R. I'm going to store it at some rate S. I could get some income from it, say a lease rate, kind of like the dividend yield on a stock, and any other benefits I can think of having physical holding of the asset. I'll call that convenience yield. Now for gold, we're going to have R for gold. Even though you think you'd have to store it, you don't have to. You can hold it in certificate form. So generally for gold, the storage costs are 0. And the lease payments are positive for gold. That's for short sellers. Short sellers of gold will pay holders of gold to borrow the gold so they can short sell it. And convenience yield for gold is generally considered close to 0. So we'll look at a little example here. I'll look at gold, and I'm going to go to my spreadsheet, and I have the current spot price of gold. We're looking at a 1.8-year contract. I was looking on Chicago Mercantile Exchange. At that point in time, the interest rate was 37.5 basis points, or 0.375%. I looked up the lease rate for gold was 41 basis points a year. We'll assume no convenience, no storage cost, and so we'll just calculate the no arbitrage forward price, the spot price, times 1 plus the interest rate plus the storage cost. Those are my two costs, minus my two benefits, any lease rate minus any convenience from holding physical asset raised to the T power. So in this case, the no arbitrage forward price for gold will be $1264.99. Since the interest rate is pretty close to the lease rate, the spot price is pretty close to the forward price. So we talked about the forward price, no arbitrage forward price for stocks. And it simply reflects the cost of carry, which is paying R and receiving the dividend yield. For a commodity, that cost of carry is a little more complicated. It's the cost of carrying the interest rate and storage cost, but we subtract the dividend yield and lease rate. The last one we're going to talk about is currencies. Suppose I enter into a cash and carry arbitrage on a euro. So I buy €1 today and finance it in the US with a US dollar loan. So I'm going to buy the euro today. I'm going to convert it to a dollar at the current dollar per euro exchange rate, and get a loan that pays R dollars. So this is the cost to purchase €1 in US dollars. I'm then going to invest the euro in a European bank and earn some European interest rate. At maturity of the forward contract, I'm going to sell the euro at the forward price, and my no arbitrage profit is the following: the spot price of the asset times 1 plus the US interest rate divided by 1 plus the European interest rate. So in this case, I'd probably use the German risk-free rate. Now this formula works for all direct quote currencies. That would be, say, the euro, the pound. However, for all the indirect quotes, say the yen and Chinese yuan, those currencies are quoted as the foreign currency price of a dollar. If you use indirect quotes, I would do the foreign interest rate over the US interest rate. If it's a direct quote, say the dollar price of a euro and the dollar price of a pound, I do the dollar interest rate over the foreign interest rate. And I did an example here of the Australian market. The 2-year US interest rate was 37.5 basis points. The Australian interest rate at that time was 282 basis points. The spot price of the Aussie in direct quotes was 89 cents. So I can calculate my no arbitrage forward price, which would be the spot price dollar per Aussie times 1 plus the US interest rate divided by 1 plus the Australian interest rate, and take this second part to the T power. So in this case, the Aussie should be selling at 85 cents for a 2-year delivery. What you see, if the spot price is 89, the forward price is 85. So the market is in backwardation. That's because the cost of carry is negative. I can finance that position at 37.5 basis points and invest those Aussies at 282 basis points. I'm making about 250 basis points per year, and you can see the annualized, or the 2-year forward price is 4.7% below the spot. And I looked up the actual market price of that forward contract. It was right around 85 cents also. So it looks like our formula was working. So a summary: the forward price must be equal to the cost of carrying the position, otherwise there's arbitrage profit. Any asset that can be cheaply stored without spoilage can be priced using a no arbitrage formula, and we say those assets are in the carry market, and those are things like stocks and bonds and currency and gold and silver and oil and things like that. However, I'll just do it as a caveat: some assets such as electricity are so costly to store, their forward prices simply reflect the expected supply and demand. So we say that electricity is not in the carry market. It would be, in other words, just too difficult to execute a cost and carry arbitrage because of the storage problems. And those assets, their forward prices are simply reflect supply and guesses of supply and demand in the future. So in this topic, we just calculated theoretical forward prices for equities, currencies, and commodities, and it all comes down to the cost of carry. The next topic, we'll calculate forward payoffs and construct forward hedges using beta and correlation.